Hello, everybody. This is Greg Owen, the CEO of the GoCo Group. Welcome. We have a fantastic program lined up for you today. We've got Harry, who's going to be right at the top of the show. So you're going to hear from Harry straight away. Later on the program, Harry will be coming back and doing a Q&A. So please make sure that you send through your questions in the chat box, and we'll try and answer as many questions as possible. I will now hand it over to you.
Okay, again, good day. And this is a critical time. We are going to see a shift that does not happen very often. It's going to be more dramatic. People are saying that governments will prevent it. No, when bubbles finally burst, they burst very rapidly. I remember my favorite story. I was in Dubai in 2007. Speaking to a big conference there. And of course, I was the only bearish guy there. I wasn't so bearish in the world either, but Dubai had the biggest real estate bubble in the world right then. And it was looking very peaky. And I said, this is a bubble and it's going to burst. And in the feedback was, Harry, you don't understand Dubai real estate. And the key explanation, and you've probably heard this before, the government won't let out. The government supports the markets. And my response to that to the audience and questions was, no, I'm really worried. It's going to happen sooner than you think. Real estate in Dubai in the next year, 2008, collapsed 50%. Now, people who would study investments, and of course I do, a 50% real estate crash is like an 80% stock crash or worse, okay? So everybody told me this could not happen, but it was showing the signs of a bubble. It was showing the early signs of cracking, and it did. So this is a time where people like, and again, the greatest example in history, two simple ones, okay? In investment, Joseph Kennedy, 1929. He got out of stocks and his financial investments after making a bunch of money, bootlegging, by the way, so not even totally legal, but he was a multi-millionaire. He got out, no sophisticated analysis. His shoe shine boys were telling what to buy, and then got back in the early 30s after an 89% crash in stocks. And of course, everything else went down with it. And he became a billionaire and political dynasty, his family. Other quick example, Ford had beat General Motors for most of the first 2 to 3 decades of the new emerging auto cycle, just like the crypto and internet cycles today, okay? And only between 1930 and 33 did General Motors, when Ford was so out there and so over-leveraged, crash harder. General Motors passed them, never to be caught again by Ford. And on top of that, a few decades later, become the largest corporation in the world. And they made most of that shift in that short period from 1930 to 33. That's the type of opportunity I'm looking at here. So real quickly, and how do I do analysis? I learned when I got into this back in the late 70s, the early 80s, really got determined for my business clients to predict the future for them. I found out that long-term trends are simple. A few key trends designed. And this is what Leonardo da Vinci said, simplicity is the ultimate sophistication, not the most complex model. Hey, that can be useful too at times, and more in the short term. But for fundamental long-term trends, it's a few simple indicators that matter. The key is finding out which ones. And they're not usually that obvious. They're under the hood. You have to find out what really drives things. And when you do, it's actually very simple. My first breakthrough indicator, after a lot of research in the early to mid 80s, I mean, I studied everything. I read 10,000 pages of Western civilization history in 2 weeks. That was just one of my projects and research, to look at everything and understand all cycles. I came up with the spending wave, a simple 46-year lag for the predictable peak in spending of the average person in the US back then, and it's still like 47 today, and it's 47 or 48 in other countries. Just move the birth index, which I had to eventually adjust for immigrants, since like you, the US has a lot of immigration. You have even more, so it's even more important with you, with Australia. And when I did that, the immigration adjusted birth index, 46 years forward, it tells me, how simple is this? When the economy is going to boom and bust over the rest of my lifetime and my kids' lifetime, or whatever, Okay, you're not supposed to be able to do this. People don't even think about forecasting past the next election because economists tell people nobody can do it. The economy's too complex. Yes, the economy's complex. That complexity works out mostly in the short term, the most long term, a few simple trends drive the economy, like new generations going from costing their parents in the economy to being highly productive, earning and spending more money to a predictable peak on average. Not all of you peak at 46, obviously. Affluent people peak more like 54, for example. But again, we can cut it that way, okay? Affluent products peak later than every day, on and on and on. The point is the future and the economy is far more predictable than you'd led to believe. This indicator told me all the way back in the 80s, this boom would peak in 2007 in the US and very close in other countries, and we would have a slowdown. Do you want to know why we're living on endless quantitative easing and it's never enough? And if you pull back a little bit, the economy goes right down because we're in this downward spending cycle until the next generation, the millennial generation comes along. Look at that next one to the right. It's a nice boom. It's nowhere near the steepness or magnitude relatively of the baby boom. So the next boom in the developed world will not be as strong. I'll show you Australia will be. You're the exception to the rule here. And Europe will hardly be there. Really quick, what's driving this? I had to find this right when it came out. First studies of consumer spending in all sectors, but especially overall. It started in 1981 in the US, Bureau of Labor, and I got on that study because I was looking for my clients to predict the future, and here it is. Average person enters the workforce late teens, early 20s, dramatically spends more as they're raising a family, peaks at 46, plateaus out into about 54, and that's the affluent people who go to school longer and spend and peak later, and then spending goes down, down, down. How predictable can you get? Average person. New generations go up this cycle like the previous class, boom, long-term boom, and then bust. Remember I said 26 years up, 14 years down. That has been the natural rhythm of our economy in developed countries like the US, Australia, and Europe since we got a middle class because of the assembly line revolution from Henry Ford, who was one of the crankiest sons of a bitches in history, okay? One of the greatest innovators of his time, like Steve Jobs today, okay? That changed the world. Middle class meant everyday people mattered a lot more to the economy, and ever since, this spending wave has worked like a charm. Now, cradle to grave, I'm not going to get into this. Let me look at it. Trade-up homes, starter homes, kids stuff, life insurance, vacation homes, cruise ships, prescription drugs. What do you think is generations are aging, baby boom around the world in developed countries? All these things, cruise ships, prescription drugs, vitamins. Oh man, you want to really make money in the next 2.5 decades? Nursing homes. Nobody's going to see that one coming. Now, here's the really good news for you guys. Australia is one of 5 developed countries, and they're all on the smaller side, and you're one of the larger ones of those. Only one few that have a spending wave that just keeps going up. If I were to look at this chart of Australia, 45 to 49-year lag on your demographic trends, I would think this was an emerging country, you know, like Thailand or Indonesia or India or China or something. This is because you have even higher rates of immigration than the US. That has kept us healthier than Europe, and you have the highest immigration rates of any substantial developed country and the highest quality Asian immigrants that have higher education and income compared to, say, the South American and Mexican immigrants. We tend to get more in the US. So your spending wage just goes up and up and up. But there's still a slowdown from 2020 to 25. Not a big one. That's not the reason you're going to see a stock crash or real estate crash, because the whole world's going to go down and bubbles burst. Here's New Zealand, your neighbor. They also go down a little more into 2025, strong recovery into 2040, and then unlike you, they flatten unless they get a lot more immigrants, which they're not showing signs of. So again, point is, I can do this with any country in the world. I showed you the US, Australia, New Zealand. Most of Europe is down after this boom forever. China is down forever. I'll show some of that later. But here's the most important part. I say it takes a few cycles. The best climate scientist, Milankovitch, decades ago came up with 3 climate cycles, 100-year, 42-year, and 21-year. Tilt, wobble, and wandering, or he calls it. I mean, things that you can measure. He has been able to predict climate change back and forward so far you wouldn't believe it. What I've done is come up with a similar model. Look at this one. You've got 3 major long-term trends. In the middle on this chart, you got the blue line, okay? That's the demographic 46-year lag, 47 now in the US, 47 going to 48 in Australia and a lot of Asian countries. Above that, you've got the most powerful one long-term, technologies, which change how we work and live. They have to innovate at first for decades, and then they move mainstream. That's when they have the power, and that's when stocks and the economy respond the most. Below that, geopolitical cycles. 17, this was one of my first cycles. 17, 18 years, things are hunky-dory in the political realm, and then 17, 18 years, like recently, bad. We're just coming out of this 35-year cycle. We will come out of the demographic cycle. That was in 2020. 2023, 24 will come up out of the demographic cycles in the countries that still have millennial generations. And the innovation cycle is the last to peak here and will take the longest to come around. On the bottom, a decennial cycle, approximately 10 years. This is sunspot cycles. Do not laugh at me. You don't want to take this seriously, be my guest, okay? It'll be to your detriment. I researched this more than anyone because I knew people would question it. Every 10 to 11 years, booms and busts in positive sun cycles. Every 90% of recessions have come in down sunspot cycles. 90%. You want to bet against that? I don't. This just refines these 3 big ones. So these cycles models together is what I designed the fund around. When are tech stocks going to do better? When are these large cap, small cap, which countries, which sectors, aging or younger? This is all predictable stuff. And in any developed country in the world, and of course I have my models for emerging countries. Now, here's the big one. The biggest cycle, again, everything has cycles important. And for stocks, the #1 long-term cycle is one nobody knows about, a 90-year super bubble cycle. And this has only been in phase since the Industrial Revolution in the late 1700s, okay? So we see a big bubble into 1835, 37, and the biggest crash and the greatest depression of that century. And then we see another one build up, bubble, roaring 20s, 1929 peak, biggest crash ever, 89% in the US for stocks, and the greatest depression in modern times. And then next great boom. Now just imagine if you'd gotten out of stocks like Joseph Kennedy near the tops of those and reinvested in the greatest downturns with the biggest, strongest booms to follow, and you're buying stocks and real estate at the cheapest prices you will ever see in your life. How does it get better than that? Well, nobody sees this coming. This is a 90-year cycle, and I'll look at that. What happens here? Every 45 years, new technologies, always a cluster, steam engines and canals, steam ships, and then the reaper for agriculture, railroads and telegraphs, automobiles and electricity and things like that. And now, personal computers, and then leveraged by the internet. And next, crypto, biotech, nanotech. This is 45 years. This is the last cycle I discovered. I kept looking and I kept trying to tie it to the demographic cycle, and it didn't. And I finally find it's 45 years. That's when I saw steamships and railroads and automobiles in my research all peaked exactly almost to the year, 45 years from each other. So cycles are real. You have to understand what's important. These are the important ones. Now, what happens when you see a major reset, okay? The last one, look at the top part of this graph. The last big bubble in the world was the roaring 20s into a peak in 1929, and then a huge crash. It actually lasted into World War II, all things considered, a deleveraging of debt. What you have to understand is in good times, especially in bubble times, and with super low interest rates, which governments have stimulated, made even lower, financial assets are going to get highly valued and way overvalued, and then they have to come back down to reality. and that makes them investable again. And the economy gets rid of bad debts, unproductive companies. That makes the economy more productive. We need booms and busts, inflation and deflation. This is what economists who are academic and don't actually run businesses and involved in the real economy don't understand. They just want a machine that grows 3 to 4% a year with 1 to 2% inflation, never has a recession. That economy will be a dead economy. Oh, we have one already. It's called Japan. Have you watched Japan since they peaked in 1989? And I was one of the few people in the world with the same demographic and technology and that called that crash in Japan a dead economy, a coma economy. They've grown average a little over zero inflation and GDP for 30 years. Their demographics are failing. They stimulated in ways that weighted down their economy with more debt and inefficiency, didn't wipe out zombie coming, and they just keep slugging into the future. It's zero. Japan will never grow again, never be a great country again, partly because of bad demographics, which they did nothing about, didn't try to attract immigration, don't encourage more babies like even China's doing today. Boom. Now, here's the key though. You look at that top graph. If you look at the 29 top, debt got major. We deleveraged 60% of private debt, and then the boom after it, which was so strong, 40s, 50s, 60s, caused government debt to be much lower as a percentage of GDP. This is good for the economy. Now look at this one. We had a peak, a little bit of deleveraging in 2008, and then central banks put a halt to it. Oh, we're not going to have a recession. We can't have a recession. Oh, that hurts. No, you bunch of sissies. You need a recession to get rid of this debt. You don't deleverage debt, you end up like Japan. And that's where we are. We didn't deleverage much debt. Now, important cycles, demographic cycles. Again, only mainly since the assembly line after World War II, middle class. We did not have a middle class. People don't get that. We had rich people, merchants, and then a bunch of poor people and peasants, okay? First middle class with assembly line jobs producing things like automobiles, okay? So that created a 40-year cycle. 42 was a generational low in the markets, and then up. Yeah, correction, but up. And then down, in the late 82, 40 years later. And then, up here. I've been saying for a long time, late 2022, we'll probably see the lowest stock prices or shortly thereafter, now that we push it off a little bit, in our lifetimes. This is not guessing. This is predictable generation cycles of spending. Large numbers of people may spend all over the place, but on average, as I showed, in the consumer spending cycle, 46. Now it's 47. 10 years from now, it'll probably be 48 I'm putting in my models. So real quickly, what do we have coming up just ahead? 90-year super bubble, more than once in a lifetime cycle, peaking with the greatest crashes and bubbles, and you don't come back. You don't see bubbles for decades out of that. People learn that you don't get something for nothing and feel like idiots after this. A whole 80-year, two-generation cycle. I'm not getting into that today, but we're at the end of the winter season coming in, which I've been predicting for decades, 42 before, 2002 this time. 40-year generation cycles, 82, 42, 2002. Again, what's the common denominator? 2002. 20-year half generation cycles, where it's the same thing. 22, 42, 62, 82, 2002, always have recessions, and boom. And this decennial cycle, which actually in the last century has been about 10 years. Longer term on some spots has been more 11, but in the last century, 10 years. And so the first few years, like 80 to 82, 90 to 92, 2000, 2002, 2008 and 9 was the only exception because these big demographic cycles came in and caused a downturn. But the next one's 2020, 22. We're in it already, and we already saw crash number one. Oh, blame it all on COVID. Yes, that was a big part of it, but we were due to come into this anyway. Late 2022 is a key point in history, and we'll go down that like late 82, late 42, and 1932 on the 90-year cycle. 32 was the only cycle that hit. It was the 90-year cycle and decennial. None of these generational cycles in the 90-year cycle it shows is the most important for stocks. Now, where I showed you that spinning wave earlier. I didn't show you up today because here's what's happened. I've been calling it for years now. The market's on crack. You pump enough money in the economy. Oh, they're not giving it to consumers until recently in a bad recession. They're just buying financial assets, bonds and stuff. And then those people reinvest that money, which comes into the markets out of the skies, adding whole new markets to the same stocks and bonds and real estate and stuff. And they just reinvest and then for higher risk and returns. And you get bubble, 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 bubble. Look at the stocks. Look how far they've gotten ahead. We should be at the worst of our economy here in 2020 to 23, something I've also been predicting for decades, not just recently. And here we have stocks looking like, oh, things are better than ever. Only artificial, created by governments. And when you create something artificial, like my Dubai lesson, when they pump up real estate and don't ever let it correct and keep pumping it up, when it finally blows, you get a big burst. So big burst coming. And the most likely worst year is 2022. And if you calculate, that's like a half a year from now. And I think we're going to peak somewhere in the next few months, if not sooner. Now, 120% overvalued on this chart, okay? Stocks, look at that, in past, they go on, never been anywhere near that. I can explain that number of things, but one chart alone will largely explain that. Profits have only gone out, have been flat since the first recovery, first few years. Earnings per share are 119% higher than profits. That's because with low interest rates and free money and easy borrowing, companies just buy back their own shares and shrink the number of shares and make it look like their earnings are growing rapidly when they're really on the flap side. A totally fake economy. And then, you know, when you hear Robert Kiyosaki next, remember his favorite term in name his book, fake. This has never been a more fake economy than that. This should be a crime to do this sort of manipulation. Now, here's the big picture real quick. Most important number in the world today on the left, $525 trillion in financial assets. 525. Biggest part's real estate, then bonds, then stocks, and then things like gold and precious metals. These things have been blown up. But I showed how overvalued stocks are. Everything, bonds. We have inflation, 3, 4, 5% in countries now, and bonds are looking like there's zero inflation. They're way overvalued because government keeps buying them artificially, pushing down the prices artificially. They're not. Bonds are not representing inflation. Stocks are not representing the real mainstream economy, only the stocks, which keep shrinking and going up from shrinkage. Not a good reason to go up, okay? Zombie firms, when you don't let a recession like 2008 do its work and bail it out too soon, the Great Depression, we eliminated tons of business, tons of jobs, bad jobs, tons of zombie companies in a short period of time, and that's why we recovered so strongly, okay? We didn't do it. Look at that. Ever since the downturn, all we have is more and more zombie companies. This is only through 2020. I just saw this number updated the other day. Didn't have it in this chart. It's now almost 21%. It just keeps going up. Companies, zombie companies are public, not small businesses. There's more small businesses in this percentage, but companies that cannot pay their debt and debt service, but they're still propped up because, oh, you don't have to fail anymore. You know, banks don't shut you down, don't force you to pay loans. Governments don't. So companies just keep limping along. So bubbles are like magic. Now you see them, now you don't. If you create something artificially, magic, rather than real solid productivity and investing money and then getting your returns back and reinvesting that in better stuff in the next trend and the next market and the next asset class, yeah. If you do it artificially, it disappears just as fast. And what do we have? Here's stocks following the money printing of the major central banks, right lock and step. And when we had the biggest surge ever since COVID hit in February, March of last year, money printing went straight up faster than ever and stocks just followed it faster than ever. Total artificial. Print money, stocks go up. Because remember, the money does not go to consumers until just recently, or businesses. It just goes into buying financial assets, more money chasing the same pool of bonds, stocks, and real estate, which just caused them to go up artificially. A fake economy. Now, people used to say, I'd say this bubble. They say, Harry, this is not a bubble. I get 100 reasons why this is not a bubble. Look at this chart. Everybody agrees that 95 to 2000, especially in the tech stocks and NASDAQ, that was a bubble. Nobody disputes that was a bubble. And it crashed 78% in a good economy. And in the most minor recession we've had since the Great Depression, a nothing burger. I'd say, you look at this bubble on the end here and say, that's not a bubble? This is the greatest bubble in all of history. This makes 20 to 29 look like a nothing burger. If anybody looks at this and say, well, my financial advisor just telling me to stay with the market, so they'll correct, but we'll reinvest and rebalance, you'll be okay. No, you will not be okay when this bubble bursts. My projection is 80 to 86% crash, very near the 89% crash in 1929 to 32. Again, once every 90 years, you get a crash. Even the crashes in the 70s, the big ones in the early 80s, like 50%, okay? This is the crash of a lifetime building. Near term, I look at this great pattern. I love megaphone patterns because they only happen at tops of long-term markets, and most analysts don't see them as easily. We've got this kind of a megaphone pattern is you keep making slight new highs, but since the economy, because you've got a boom that everybody wants to keep going and believes will keep going, but the fundamentals are weakening, so every time you have a crash, it goes to lower lows. This says, and I think we could go a little higher, 44, 4,500 here. The next crash, the target would be 2,000 on the S&P 500 in the US. 2,000, that's a 56% decline. And how long will it take that to happen? 2 months, give or take. These crashes happen very quickly. February to March, that was a month. But that was shallow. This one might take 2 months, 3 months max. This is going to be the #1 goal of the Dent Sector Fund, is to protect you from this crash. Not just protect you, we're not gonna be sitting in cash, okay? We're gonna be getting in the long-term, high-quality bonds that actually appreciate and actually are the safe haven, unlike gold that ended up going down in the 2008 crash after going up at first. A lot of things went up at first. Corporate bonds, gold. Then they crashed when things got bad. Only the Treasury bonds surged in the US and Australia. But even Australian bonds got hurt when the US Treasury became the global safe haven instead of the Australian government bonds being the safe haven and AAA corporates, okay? So this is an ominous pattern. Here's the US demographic, workforce growth. We just saw a peak, 147 million people employed. It's already dropped with COVID, but here's a secret, and I don't have time to get into this. Over half the people that got unemployed, even when the economy came zooming in, didn't come back. They said, oh, I like people. Oh, and the government gave such benefits. Or, hey, now that I'm retired, I started a little business on the side, I'm selling widgets to somebody. They didn't come back. Workforce in the US with demographic alone is going to continue to trend down and be down 4% 10 to 15 years from now. How do you grow when the number of people making and spending money is actually shrinking for the first time in modern history? This has not happened before. All developed countries, Japan's already been through this, and look what happened to them. US is going through it already about. You're going to follow much farther down the line. Your problem is the rest of the world more than your own economy, and your economy is your own super overvalued real estate. I know you don't want to hear that, but you're going to hear that from me. The best advice I can get you, do not think your real estate won't go down. Everybody says that before every bubble, including the Dubai people. China, second biggest country in the world. What do they look at? They've already peaked on their kind of spending wave, 2009. They go down even more sharply into 2021. They come back, very little millennial boom, and keep trending down further. China is the first emerging country, the first and the largest today and the second largest in the future to India, to peak, and they have almost no millennial boom in the future. They just go down forever. People think China's going to grow forever. They've been growing more towards urbanization and no longer demographics. So how's the world's going to grow with the two largest countries in trouble, especially China? Gold. Gold has a 9-year cycle in some cycles. It may have peaked at 2089 here recently. I think there's a shot because in the early stages, if stocks start to crack and the economy starts to weaken, gold at first is, we'll be the safe haven. But I think people are going to remember the last time where it went up in the first part of 2008 and then crashed 33% in a couple of weeks, okay? So gold may make us lighten up, but I'm telling people gold is not going to be your savior in this downturn. It wasn't in 2008 in the end, it won't be here. Not the worst place to be, and if you want a little diversification or you want to hedge in case I'm wrong and the gold bugs are right. Okay, so you can have a little gold if you want, just not a lot. Treasury bond, US Treasury. Now, also remember what happened in 2008. US dollar spiked at the worst of it from mid to late 2008 against all currencies, including your solid Australian currency and your country with better demographics and less debt. It spiked anyway, and even your bonds went down relative to that. Look at this chart. People don't think you can make money on a Treasury bond that's yielding 2 to 2.3% today, a 30-year Treasury bond. Look what happens here. 30-year Treasury bond in the scenario where I'm saying where interest rates just fall from around 2-ish to not 0.4%, okay? Oh, it could go up 38% in a crisis where stocks and real estate and normal corporate bonds and junk bonds especially, everything else is falling. You don't make that 2% and preserve your money. Wouldn't even be worth the risk for the 2%. These things, this is where they appreciate the most. Zero coupon bonds where you strip the interest. TLT is an ETF you can buy in the US, would do is 20-year instead of 30, 22% in this scenario. See, look how better though the 30-year does. I tell people the longest term Australian bonds and the longest term government and the longest term treasuries, but you buy the US first, benefit from the dollar, safe haven, their safe haven, and then after they've made a big run, then the Australian bonds will probably do better for the rest of the crisis. So that's something else the fund will be looking at. Real estate, real quick. I know you guys are gonna love this stuff. You got the second best real estate market in the world, only second to China. And you got the demographics to back it up long term. But here is another breakthrough I had several years ago. I could not make a correlation with the Japanese. Yes, the Japanese fall I saw coming in real estate and stock, but I couldn't understand when the millennials, and they did have a millennial generation in Japan, which actually is peaking in 2020, last year, why real estate, stocks came back with their spending, but real estate didn't. Then I realized real estate's unique. It lasts forever, unlike other products we buy and things in the economy. So I had to subtract. I had not just had to put in a lag for peak spending. I had to subtract the dyers because dyers are sellers, whether they pass it down to their kids for free and the kids don't need to buy, or they sell into the market when they die, they're sellers. So when I came up with this net housing thing, I finally got a better correlation with real estate markets around the world, including Japan. And here's what it says for the US first. Last time we had a downturn, and that was predictable, 26% decline in real home prices. Well, net demand went down less than that, but that was a predictable thing. Now look at this time. People tell me now, they say, well, Harry, yeah, this real estate, yeah, but this real estate bubble is only a little higher than before, and the economy's bigger. What are you bitching about here? Okay, what are you warning about? It's no big deal. No, the fundamental demand is way lower. People usually buy their biggest house at 42, and now they're buying them at the 50 and 60 because when you can borrow money for nothing, you can buy a bigger house than you need, or buy two of them, or buy a vacation house you don't need. So when I compared the fundamental demand, the blue line, and now real estate adjusted for inflation near the same levels as 2006 when it peaked last time, shows up to a 56% downside. Now, stocks go down 56% and then bounce back, no big deal. People borrow against real estate, you know that. Real estate makes the worst depressions and downturns because people borrow against it and it's their primary asset for most people. Here's Australia. I would have expected Australia to do better. You do great on the spending wave, even with some decline in the next so many years. You do great on that, not on real estate because of this time. You have a giant baby boom, even though you have a lot of millennials coming from other countries, you still have a giant baby boom that will die into the early 2040s like the US baby boom. So here, you are 42% overvalued from the top down to the bottom of your cycle. A lot better than the US, by the way. You will come back for several years in the next boom, and then it starts heading down again with a dying, oh yes, end of the early 2040s, just like the US The dying of the baby boom causes this slide. Now, here's a difference between the Australian chart here and the US I showed you just before. You don't go negative. US actually goes negative. Japan's been negative for years. China will go negative in net demand. You don't go negative. So your real estate can still grow in the future, but I'm telling you today, you're going to see a bigger crash than you expect in the next few years, and you will not see a bubble or boom. Real estate will not boom nearly as strong in the future, although I would be happy to buy Australian real estate after this crash. I would be very selective in the US. Here's Shanghai, biggest real estate bubble, China. They're the only ones worse than you. This chart, and this is a reliable pattern. I'm not going to go in this too deep. I mean, I can tell by the boom in certain metrics, most real estate's got 30, 40, 50, 60% downside. And that's huge in real estate, and more than we saw in 2008. This for Shanghai says it could be 78% in real. You know what that'll do? Chinese don't have as much debt as you guys in the US and in Europe does. But real estate is 78% of their net worth, and they're going to be awfully pissed when that happens, okay? They're going to lose their entire net worth. And you think they don't clamp up in spending when they have only been affluent for a short period of time? I'm telling you, they will. Oh, they're your best export customer, by the way, for 20% of your GDP. So real quick, here's the spread. I mean, real estate is a rainbow compared to stocks. All stocks go up and down together. Real estate doesn't always go down at the same time. Much difference in valuation. Hong Kong, China, the worst. It is Vancouver, Western Canada, and Eastern Australia that are the next most overvalued. And then it goes into California and Hawaii and London and Toronto. Miami is where I'll end up moving after Puerto Rico. Miami actually looks like a bargain, but you wouldn't think so if you were there right now because it's expensive too. Everything's bubble. But again, you're in one of the most extreme bubbles. You do not have the demographic forces as strong, so your downturn will come back sooner, will not go down as deep as it could, but your overvaluation is your biggest problem, and it is severe. Now, so what's the future? The future is the emerging world. You're one of the few demographic countries, okay, that have a long boom. Here's China. China already peaked. Japan in 1989 to 96, a kind of a double top, was the first developed country to peak in their baby boom spending wave. And then every country developed around the world has followed. And the last one is South Korea, okay, just peaking recently, okay? China is the first emerging country to peak, and more will follow, but that'll take many decades. Most emerging countries don't peak until around 2035 to 40, and there's countries like India don't peak till 2050 to 55, and Africa 2100 if they ever join the capitalist game, which they will sooner or later, but no time soon. China's already on the decline demographically. They still have some urbanization, but they've cashed in most of that for a long time. Here's East Asia, everything but China, South Korea, Japan, all the other East Asian countries, they peak collectively. First peak in 90, that's Japan. Second peak, South Korea, everybody else, Taiwan, and then they just go down forever. Nothing like Australia. Even no echo boom, no millennial boom. East Asia has been the strongest part of this boom since 1983. US, Europe, Australia, everybody's done well. They've been the strongest. They will be weaker in the next boom, and it will be Southeast Asia and India. So again, here we look at this. India goes straight up, continues to go straight up into 2050 to 55 and only tails off, and that may change by then somewhat. They start tracking them. Southeast Asia is almost identical to this, okay? So that's the growth. Asia is the growth in the future as it has been for decades now. Western countries, developed countries peaking out one by one, slowing to lesser or greater degrees. Southeast Asia and India are the greatest growth areas for demographics and productivity. Hey, Middle East has good demographics, Africa even better, but the productivity is not as strong. That may change over time. Note, real quick, from observing so much history, 10,000 pages was my first start, okay? We have moved affluence around the world, from the Middle East, up into Northern and Western Europe, to North America, to Australia and East Asia, and then what do we keep going around the world? Southeast Asia, India, Pakistan, Middle East, Africa. This is the story there. Everybody's going to get, countries that do real well get complacent, and then the countries next to them say, well, we want to be rich too, like Japan first, and then China and Korea and all that. It keeps moving around the world because people get motivated when they see their neighbors get richer. The other thing I look at, even more powerful, that 45-year technology is like urbanization. Urbanization, people in urban areas make 3 times the wages of rural on average in places like Brazil, China, and India. I've measured this in the biggest countries. It's pretty consistent, 3 times. So simply moving somebody without the education, that'll come later, into places where there's much more variety, much more specialized, much better paying job, causes huge growth. This is what has been behind. China has been over-expanding everything to urbanize and to get that factor. The problem is they now have 22% empty condos and houses and infrastructures, and they don't need to build another thing to go from 60 to 80% kind of like peak urban. So China doesn't have that factor anymore, but India. Now in early stage, and I'd like to see a little more data on this, early stage says today, if you don't measure India against China today, 740, 7,435, PPP adjusted and inflation adjusted versus 18,000 in China. You measure them when they're at the same 30%. Oh, India's higher back then. So I project these slopes. So demographics, predictable booms and busts. Urbanization happens in most countries on a predictable straight line, occasionally S-curve relationship, and I can predict how fast countries will urbanize and how rich they'll be decades in the future. Another predictable thing that economists have little or no clue about. India could be the richest country in the world 20, 30 years from now. China, Indonesia, India, South, all these, you are the closest developed country, especially English-speaking country, to the greatest growth in the future, countries like these. And India ultimately should be the greatest if they don't just plain out screw it up. Now, real quick, Bitcoin. People say, oh, this is nothing. No, Bitcoin and blockchain technologies, which it really is a kind of representative, a banner for. This is the next big thing, like the internet. Look back here. The internet had a bubble in its early stage. Remember, the whole tech bubble was the 90s, but particularly late 94 to early 2000. The internet stocks came in 97, 98, like when Amazon, that's the red line here. The blue line is the overall internet index. These things have what I call a baby bubble in their early stage because people see, oh, these are the technology of the future. And they are, but they're only 1%, 2%, moving towards 10%. They don't affect the economy that much. And tons of companies enter, and you have to shake out most of them, get down to the 5 or 10 that matter, okay? That's what's happening now. We're in the midst of a shakeout in these crypto and blockchain stocks and companies. And the future is going to be unbelievable. I keep saying blockchain and crypto is the internet on about a 20-year lag. And every 45-year cycle has 2 big technology surges. Internet first one, blockchain second one. This is the next big thing, but it has to go through a correction first. And the greatest opportunities in this downturn will be the blockchain and crypto thing. There'll be other technologies, biotech stuff. Biotech will never grow as fast as crypto. Because crypto is the digitization of all financial assets. Internet connected us with information, okay? This is connecting and digitizing and making more efficient all financial assets, and wealth is way greater than bank accounts. This is a huge thing. The best time to invest will be in the next correction. And real quick, Bitcoin right now, people saying, well, yeah, it may be done. Well, I just see this chart the other day, and I look at this stock to flow measurement on the bottom, these red going in green, lines down here. Before the last peak in late 2017, Bitcoin hit a bottom on this measure just before, in early 2007, just before its last big surge. So I was even thinking Bitcoin may be done at 64 here recently. I look at this chart, oh, this looks just like, oh, the next several months. And by the way, cryptos also peak almost exactly in 4-year cycles, late 2013, late 2017, late 2021. If we see one more big surge in this after this correction, then 100 to 115,000 would be the target. So here's this correction right now. I'm looking at this giant triangle. If we break down out of this, then it could go lower, and that's a different scenario. If we break up out of this, which looks more like the trend here, this thing's heading for 100 to 115,000 by a lot of good measurements. I can't get into all of that, and you got a better expert coming on after me today, okay? Now, here's the NASDAQ. I think we're in a peaking pattern in stocks here. Here's a classic, slightly a triangle top, makes slightly new highs. We break down, not too far from here, 13,400. It would say, get out of stocks. That'd be a clear circle. I say, after 3 tops like this, I'd be taking money off the table now. But if you really want an even better, clearer signal, this thing breaks below that bottom trend line. The first crash will be the worst. Stocks are going to crash 65 to 80% plus in this sort of 90-year cycle bubble burst. But the first crash is 40 to 50% historically. And this is through 7 bubbles I measured in the last century. So the biggest crash comes first. So again, what are we doing in the Dent Strategic Sector Fund? We're going to be out of stocks. We're out of stocks right now, except a little bit. And we're going to be modestly short them and getting into those treasury bonds, okay? US dominated treasury bonds. So when it really gets bad, we get the dollar kicker for you and the bond safe haven. This is the S&P 500, similar thing. I was saying, it looks like we could have one more surge up into maybe late July, but hey, if we break this thing near term, different story. But right now, well, let's say we go to 4,500. That's my best target late July. And then we start going out, we break this trend line, not that far down, 42.20, curtains, 50% crash in a matter of months. This is what we're going to protect you against, and this is what you need to be looking at your value. This is not what I'm saying here. Whether it's the Dent Sector Fund or your investments, first of all, do not listen to your financial advisor. I'm sorry, I love financial advisors. Most of the time, they're an objective thing to keep people on the rail and from panicking and doing stupid things. It's good what they do. Not now. They're going to say, oh, don't worry, corrections, we'll just rebalance. No, not out of this, okay? This correction is going to come fast and hard, and it's going to be the beginning of the even bigger one. And again, here we are seeing the China market. It keeps spiking to lower highs, and this thing is going to go down. It's already down so much you think, well, how much more can it go down? Even from these levels, 3,500 is up. If it just goes to 1,000, my minimum target, 73% decline. If it goes to 334, my max, 91%. So even when stocks go down, when they go down, it's still the ratio of where it goes to that bottom can still be very high. So big crashes ahead that I see. Okay. So, and again, here's the Australian market, You don't go down quite as much. I would say the 3120 here is a realistic target. If that's where you bottom, that'll be down 58%. That'll probably be the best stock market performance of the major developed countries in the world. So don't sit through it, but be happy you're in Australia because of your better demographics stuff. I think you may go a little higher, but again, first crash. What does that first crash take you? Back just down to the lows last year. That'd be a 40% crack. 40% in Australia, 50% plus in the US. That's what I'm looking at in short order here. Now, here's the secret. I'm telling you, I listen. I mean, the best people in the world, some of the gold bugs who see this crisis coming like me, a lot of leading edge investors, and they're all saying, yes, the bubble's going to burst. And then they're saying, you got to be in gold, in commodities. No. Commodities have already crashed and they will crash again. Remember what I said? Even from lower levels, going to these lows like down 78, 80% can still be 50 or 60% from where they're at. So again, TLT, the red line here is 20-year Treasury bond average. It's a fund you get an ETF you invest in. I mean, if you're an Australian and you're investing, you're also getting in US dollars, so you should get an extra kicker for that. TLT is 20-year bond. Look at that said, it could go up 40-some% when stocks go down 56% in their first crash. So it's not just in the Dent sector fund, oh, we'll be safe and wait to rebuy like Joseph King. No, we're going to be in these high quality Treasury bonds, AAA corporates, and at the right times in Australian bonds, because they're some of the best. Just the US bond in 2008 through this trumps when things go really bad. We're going to be in that US Treasury bond in different ways to play this downturn and actually make money when things fall rather than just preserve it. So real quick, summary, you got to sell stocks into any new highs or take, average into this, but this is not average over a year. This is average in over weeks or months, okay? You can either get out or average into this, but you need to be getting out of stocks sooner than later. Now, if stocks do start to crash and you see that first sharp crash, which will be very obvious when it happens within just a few months, that's telling you real estate's going to now follow. Real estate led the last downturn, 2008-9, because real estate was in a different cycle. It was in a weaker cycle. Real estate is in a stronger cycle because of millennials right now. So it'll be the last to crash. Stocks will lead. But when you see stock crash, and then you better get serious about moving your real estate and take that offer and don't get too greedy. So sell all non-strategic real estate that you don't want to live in forever. I even sold my main home. I just bought one in Puerto Rico because I got the deal of a century. Otherwise, I wouldn't have touched it. Cash flow positive during the downturn, multifamily, rentals, apartments, medical facilities, and REITs, real estate investment trust investment, can do well in a downturn. So you got your short stocks, long, high quality bonds, and you can be in some kind of multifamily rental kind of real estate. Best safe havens though, in order, US Treasury bonds, longer the better, 30-year, 20-year TLT fund, 10-year. Why buy the 10-year when the 30-year is better? But whatever. AAA corporate Owen. Every bonds benefit from falling interest rates and a deflation shock, but they get killed by default risk, okay? Anything that's not close to AAA will have the default risk factor and go up in yields and go down in price, even though interest rates are going down, which is usually favorable for bond. That's the trick. Create cash and cash flow now. Don't just sell your stocks. You got a vacation home. I just sold a vacation home. The best view in Puerto Rico. I used to show the slide. I'm not doing that today. Okay? I sold it because they don't use it that much, and it's a royal pain in the ass to maintain on a damn near deserted island, upscale house. Sold that thing. Oh my God, am I going to be able to redeploy that money? Look for proven investment systems that thrive in volatility. I've been saying this for years now. That's why in Australia, every time I go over there, every time I do that, I'm always promoting Sean Allison. He has a track record. Oh, options. Oh, options are risky. No, the smartest investors use options to limit risk because you can take a small amount of money and use it strategically to hedge something else, or you can use them in the right kind of short-term strategy like Sean does to actually make money in a up market, in a down market, or a sideways market, as Greg said earlier. But here's the truth. What did I just show you earlier? Markets and bubbles go up rapidly. What do? They go down more rapidly. Stocks go down. Normal bull markets and bear or bubbles and burst, they go down twice as fast as they go up. So they go up faster in a bubble. They're going to go down faster. And that creates opportunities for people like Sean Allison. That's why we're bringing you to him as well. We want to not only tell you, okay, be on alert, you can get in the Dent sector fund as a core fund. We can help you manage this risk. Sean Allison is the place you can put some of your money and get a kicker. And I'm telling you, the track record is very, very good, or I would not be touting it. So again, thanks everybody for listening. I will be back for questions later, so get your questions ready. This is the time to ask them. Thanks for being a good audience.
Now, as promised, we're going to bring Harry back, and we're going to look at a few questions that have come through. So Harry, bringing you back in. Are you there, my friend?
I am, Greg.
Terrific. I hope you've had a nice strong cup of coffee and you're ready to go. All right, Harry, look, the first question, we have a number of questions, so I had to sort of pick and choose and just fine tune a few things. But one question here, what do you think of digital US dollar? They are saying they will be able to track our purchases and will do away with paper money. Will cash disappear? What does all this mean?
Well, good question. I mean, first of all, cash has been disappearing for a long time. It will continue to. And now that people are seeing that Bitcoin and crypto is not going to go away, a lot of people say, oh, this is just a fad. And, it's just a little bubble and stuff. Everybody's saying, well, we need, most countries saying we're going to have, and of course, some have actually formally done it, we're going to have our own digital currency. Well, this is inevitable. That's the whole point. What I was saying about crypto and blockchain in the first place is the digitization of all financial assets and money. It's the money side, it's the asset side. So everything's going to go digital. But what I see is that governments are seeing they're losing power. So they want to say, well, we're going to have a digital, don't have to worry about Bitcoin, crypto, and Ethereum stuff. We're going to have digital currency. Well, the dollar will be digital, or the Australian dollar will be, or the Zimbabwe dollar will be digital. That's not the purpose here. The purpose is to create a global monetary system that is more fair, more efficient, more unilateral, that cannot be manipulated by individual countries. That's all countries do. Countries buy their own currency to push it down so their exports will be more competitive. That's cheating, and it actually has to take money to do that, so it's got an expense to it. And same thing, countries print money today and put it into the system to push up financial assets or to send it to consumers so they'll spend more today. Well, that just means they won't spend more tomorrow. It's manipulation, and it's a way countries can cheat to grow faster than normal or faster than other countries. That's not good for a world economy. A world economy needs to be, it's kind of like the racial thing. It needs to be non-racial, non-monetary. Countries should be competing on a level playing field. And so what you really need is a global currency. What I see, and I don't know how this is going to work out altogether, I see a use for Bitcoin kind of different than a lot of people do. I see Bitcoin continuing to grow as the standard bearer for the digital movement, for the blockchain, and it becomes the standard. Gold for hundreds and hundreds, even thousands of years, was the backer of fiat or country currencies, okay? Everybody had to tie it to gold to keep them honest, to keep them from cheating too much, and gold was that standard. Well, gold can't be the standard for crypto. It has no relationship to it. Gold production grows at 1% a year. The world economy is growing at 5 to 6 typically. Already, we need a new standard for money. So I see everything going digital in all types of different forms. And you'd have to speculate, well, we have all these subdivisions. Oh, you buy, certain things with this coin and certain things with that coin, or do you just have a few dominant coins, like Bitcoin and Ripple or something? Ripple's actually very efficient for transactions. Bitcoin's not. I see Bitcoin becoming that standard. If Bitcoin would get up to $500,000 a coin, which could easily happen in this progression in coming years so far, that it would be the same size and world value as all the gold in the world. And all the gold in the world is like maybe 11 trillion a day, but only 3 of that's used for financial purposes. So it wouldn't even take that for Bitcoin to get up to the same backing potential in a monetary thing. And if it goes up to $1 million a coin, which I see, Kathy Woods of the ARK, ARKK fund, is saying she sees down the road Bitcoin being maybe peaking out around $1 million. That would be enough for a lot of growth and for Bitcoin without just sitting there doing nothing. People can still use it, but people would keep their reserves to back their currencies or to back big financial transactions in some fraction of Bitcoin, like they may have done gold in the past. So I see Bitcoin being the standard, and then it'll all be, why would you buy anything but digital? I mean, dollar bills can be stolen. They're pain to carry in your wallet, and get change. I mean, I spend half my time waiting on not so smart people to give me change, okay? When you just swipe your card and it's all digital, boom, done. You want to put a tip on, done. So everything's going to go digital. So the question is, what wins the digital game? What's best for the global economy that we end up, at least in the developed world to start, and ultimately in the emerging world, we end up with a global kind of maybe Bitcoin-backed digital system that is fair and a level playing thing for. I mean, I always tell people in the United States, I mean, it's different for Australia, okay? You got 5 cities and so many. What if the US, what if all 50 states in the US have their own currency? It would be ridiculously complex. Every time you buy something from another state across the border, you got to switch currencies like we do when I go to Australia or Europe. It's ridiculous. One currency is where this is going, all digital ultimately. And I think Bitcoin's only function, since it is not the best coin, efficient, is as a standard, and that could be really powerful.
Wow, Harry, that is breaking news right here on the GoCo channel, what you've just said. Amazing stuff, amazing. So that leads me into another question. Of course, Robert Kiyosaki came onto the show some 12 months ago. He said that banking stocks were going to be in big trouble. He did make a call 12 months ago to get out of bank stocks. That may have been a bit too early because they've doubled since then. But the reality is, he said bank stocks we're going to go down. They may go down one day, but not just yet. So what's the future of banking, Harry?
Well, you know, they're already starting to crack. And again, this whole digital thing, once you get people on a digital network around things like Bitcoin and cryptocurrencies, loans can be made by computers. Computers can just calculate your risk just like a person at a bank does, lend you money at a certain rate depending on your credit rating and risk, and do all that without banks and without intermediaries. That's the whole point, and that's the reason that banks will be digital and country currencies will be digital. They're trying to escape this thing. This thing is taking that middleman out. We don't need every country to have its currency. We don't need, you know, all these different things. A lot of things banks do can be done by this, and people can just negotiate with each other directly to borrow, lend money, to invest in new ventures. You're going to be able to invest, or you already have websites where you can invest in a collection of new ventures and spread your risk. And you really got to do it there, because I lost a lot of money in new ventures, not spreading risk. You know, it's so this is the way things are going as well. We remember the definition of blockchain and cryptocurrency is the digitization of all financial assets and money. So everything becomes on this manipulatable, calculatable thing, and it makes the whole system more secure, more trustable, and more efficient, and easier for more people to borrow and lend money and invest in different ways. Oh, you have to have certain money to get in this fund. Oh, you have to, no, you can borrow $10 if you need to in this sort of system.
Wow.
To buy an ice cream cone. You can't.
Harry, this is good stuff. Harry, now Jim Rickard said just recently, even taking it a step further, that eventually, in the not too distant future, credit cards will disappear.
Same thing. That's right. I mean, they have to check your credit. They have to, like, you know, track your stuff. And all. Computer. See, here's the thing. I've been saying this for 2 decades now. Digitization. What computers do, the biggest down to the smallest in your hand or in your pockets or in little machines, they basically automate all left brain functions. They can't automate intuition yet. They'll probably do that one day. Anything left brain, accounting, banking, you know, all this stuff we're talking about, credit cards, it's just calculations. Well, they can do it at light speed, and they can do it at small levels efficiently. If a person has to intervene and approve something or something, oh, it costs lots of money. So you got to take people out of the system. You got to take layers out of the system. So a person just needs to borrow, person just needs to buy something, and they're doing it directly. And yes, a credit card should not have to charge 2 to 3% for a transaction. It should be 0.1%. So yes, all of this blockchain, all of this digitization of money makes the whole system more efficient. Again, the internet has done this for decades. I used to have 3 research assistants full time. Now I share one with my partner, Rodney. I have half a research assistant to do the same level of more than I used to do with 3 10 years ago. Information, what internet did for information access and communication, the blockchain and cryptocurrencies do for money and financial assets. It's a huge thing.
Robert Kiyosaki said 12 months ago, bank shares, sell them. Got the timing wrong because they've doubled. What are you going to say?
They are going down the fastest now, recently.
Okay, so you're saying very soon, time to get out of bank stocks?
Yeah, absolutely. When they go, they will be. I mean, the banks got bailed out. They didn't even deserve this. A lot of banks should have gone under. So there's a lot of banks and financial institutions of all types that would have gone under, that got kept going along, zombie companies like I showed in one of the charts in my presentation. They are going to fail the fastest. Yeah, the banking and financial sectors, when this bubble bursts and really gets into the burst like it did. Remember, the 2007 top in October, stocks and things went down slowly at first, and it was June 2008. That was about 8 months after the peak. It just, Lehman Brothers, some banks went down, and then all types of stuff went down. Everything went up, and that's when even gold collapsed, 33% in a few weeks. All financial assets will go down to reality when this happens. And the bank stocks are going to be, yes, and financial sectors are going to be some of the most vulnerable, because this is a big financial Ponzi scheme. All this stuff we've been doing for decades and years now.
All right, I'm going to mention the elephant in the room early, and that is, people ask this question, so I'll put it into my own terms here. They keep printing money. It's absolutely sent the economic cycle off the track. It derailed it, absolutely smashed it. Will they keep printing money? When will it stop? How long will this go on?
It won't stop until the system, the bubble itself, gets so extreme that it crashes faster than these people can react. You got to remember, in the first place, remember what I just said, 8 months in the stock top and the recession starting to build before things really got nasty. And when they did, everything went down. Banks went down, all this sort of stuff. And that's when they printed massive amounts of money. And that eventually got us out of it. What I see has happened, the key thing that happened with COVID was such a shock short term. It was a mini depression. They had to really step up. Greg, I've calculated that since the repo crisis, and that was only a small part of it, when they started to taper off and the banks got short of funds, and then all of a sudden they had to borrow, and then they had to start printing money rapidly again. In other words, tapering didn't work. The system still needs this crack and stimulus to keep going because it's dead underneath, Well, it just got worse. And then it finally collapsed sharply in late 2008. Most of that crash and the damage done was between June and November of 2008, just so many months. So when this thing cracks, it's going to crack hard. And what the central banks just did, including now governments, I calculated in the United States that between the monetary stimulus since the repo crisis, just a few months before COVID, and then after COVID, and now the fiscal stimulus committed on top of that with more promised every day, is up to 65% approximately of US GDP. You can't spend 65% of your GDP to keep an economy limping along long-term at 1.5%, 2%. Actually, the growth of US GDP since the 2008 bottom in the money printing started, 1.6%. So massive money printing just to grow at 1%. But when you go to 65% within 18 months, how are you going to follow that out? Are they going to do 100% next time in 3 months? There's a point where it's so ridiculous and so massive, and the response is so it's like, oh, the economy's growing kind of fast. Not compared to 65% of stimulus. You could have just given all that money straight to consumers or sent them washing machines and cars for all that money and done way better. When it doesn't, when you get more and more, and it does less and less, and it is a diminishing returns thing. I've said that from the beginning. No artificial scheme can work because it's not real investment, real returns, real reinvestment at high returns again. It's just throwing artificial money in and propping up something already dead. It has diminishing returns. So there's a point where anybody looks and says, well, this is ridiculous. I think it just got ridiculous. US 65% of GDP to fight the COVID crisis. So again, what are they going to do? Like I said, 100% next time? There's a point where people say, what? There's a point when where the smart money finally caves and says, okay, we're shorting this thing. When the smart money who has concentrated money, when they short the market, they don't short it. They don't go like, oh, I'll short stock. They short 10 to 20 times leverage. They hit it like a hammer. When they turn around, the Fed will not be able to compete with them. That's what I'm saying. And again, every crash faster and deeper until it gets so fast they can't get ahead of it. They barely caught this one, and they won't catch the next one by my estimation.
Harry, the very well-respected economist Jeremy Grantham, who I think you know quite well.
Oh, yeah.
Jeremy said, we are only months away from the biggest crash and disaster of history. What do you say to that?
I've been saying that for years and years. Bubbles burst, and they burst faster than they build. And the greater the bubble, the greater the bust. I've got all my books, I got 10 principles of bubbles. I'm not going to go all that here. Bubbles are bubbles. This is a bubble. What Jeremy is, he's a very wise man. Unlike me, he comes out only when it is this close, and you got a way higher chance of being right. And he's right about it. This has to burst. I mean, I've studied every bubble in history. And in all different countries, and not just stocks, but real estate and tulips, and I mean, you name it, all types of stuff. Bubbles always burst. They've never been a soft landing to a bubble ever in history. And people now think, yeah, this bubble won't last forever, but the government will let us down slowly. I'm telling you, they're having to double down, double down, double down, double down, till they get so leveraged that, like I said before, that crash will be so sharp and steep that they won't be able to pull their guns out fast enough before they get hit by the other shooter. They are creating the very monster that will kill them. They're saving the economy from a debt crisis by creating a financial asset bubble that makes at least the top 20% feel richer, because it doesn't do much for the average consumer. And that bubble is going to burst faster than any debt bubble. For a debt bubble to burst, people have to go in Chapter 11 or renegotiation and da-da-da-da-da-da. No, financial asset bubbles just go bam, 40, 50%. How do you like that, Mapples? That's what's going to happen. A debt bubble doesn't burst that fast. So this financial asset bubble has been created by the central banks, and this financial asset bubble, which is what's going to kick their assets. Okay? That's what's going to happen. They basically shoot themselves in the foot by exponentially printing more money. Okay, like a balloon, you can blow it up, blow it, especially slowly, blow it up. Any balloon will pop at some stretch. And poof. When it pops, how fast does it pop, Greg? Boom, pops, boom. That's what's going to happen to this thing at some point. And again, I love seeing Jeremy come in. He's a little wiser now. He's been around longer. He is one of the granddaddies that really sees risk, understands bubbles. When he comes in and says it, you really should listen. So I love him coming in. I'm very happy to hear him chiming in here.
Jim Rickard's also another man you know very well and you respect greatly. I've had a lot of questions about gold and silver, so maybe you'll probably cover everybody's questions with this question. Jim Rickard said, when I interviewed him recently, that gold was heading to 15,000 US. It's about 1,800 at the moment. And I asked him when, and he said in the next 4 to 5 years. Now that sounds like a miracle, but at any rate, what's your thoughts? Will gold go up that quick? Will it get to 15,000 in the next 4 or 5 years? And also silver. What's going to happen to these two precious metals?
Well, silver goes up faster and crashes faster, but if it really becomes a monetary crisis, gold is the ultimate thing. Gold would go to levels like that only if we have a hyperinflation scenario like 1920 to 23 with the Weimar Republic. This has not been the trend so far. This does not compare to that at all. Those sort of hyperinflation scenarios, Greg, happen when countries or people in countries have to borrow from foreign countries because they don't have a strong banking system. So it usually happens in third world countries or weak countries. And then when they start to default and stuff, not only does the defaults happen and the banks do them, but their currency falls for the country that's having more defaults, and it's the fall of the currency that makes the debts to the foreign borrowers go up exponentially. That's what a hyperinflation is. You don't go, in this case, from 0% to 1% to 2%. Now we're at about 3% inflation. Look, you know how much money we printed already? You know, like $100 trillion and stuff. You counted it all up in the last survey, more than any time in history, and we're still sitting at 2-3% inflation in most countries. If that only created that much, you don't get to hyperinflation here. We may get to 5 or 6 for this thing go, and even that would cause bonds to go down in value and cause stock valuation to be in question and cause this bubble to burst. So you do not, I'm telling you, you do not get hyperinflation here. You do not get gold at 5,000 to 10,000 in any scenario I see, except for Weimar Republic, and that is not what's happening here. The US does not borrow foreign like other smaller countries and some countries do, and we couldn't create hyperinflation if we tried. And I've been saying that for years, and it's still, even with this 65% of GDP, we just gone from 2% to 3 or 4. Come on, that's not hyperinflation. And it would take hyperinflation to have gold go to those prices. And gold has gone down even recently with this surge in money printing. It's gone down again. It was in 1900 and something, and then it's down, no, 2089. Now it's back down into 1800, 1760. It's gold is an inflation hedge, not a deflation hedge. And the next step in this process, without question, if you look at history and the progress from spring to summer to fall to winter and bubbles to burst, bubbles always create deflation because financial assets and money collapse and there's less money chasing the same goods. Deflation, gold does not go up to $5,000 in deflation. Treasury bonds go up. That's what goes up in deflation. Look at history. No question about it, and almost nothing else does. Deflation kills all financial assets except the safest bonds, period.
So Jim's prediction.
Collectibles go down. Art, you name it.
Jim's prediction, 50,000.
Mine is 1,000, give or take $100 in gold at the bottom of this crisis. And then gold will do very well in the next global boom because the leading countries are going to be China to a lesser degree and now Southeast Asia and India. And those are the countries that love gold the most for normal reasons, to wear it on your body and show off your damn wealth, okay? Gold will do well for fundamental reasons rather than inflation and monetary and all this sort of stuff. Gold is losing its monetary value. And that, again, blockchain and Bitcoin is here to replace gold in a digital world. Gold is not going to have that role increasing in the future. So I love Jim and all these people because they realize you don't get something for nothing. Money printing doesn't work. It always collapses. I don't see gold as the safe haven. It was a safe haven in the 70s, not in the 30s, and not now, especially not now, with the digital threat on top of everything else.
Well, obviously you and Jim Rickards and Peter Schiff all disagree big time.
Well, he and Peter agree more, although they have some differences, but I disagree on both of them. And it's not about the crisis. It's not about irresponsible government spending and stimulus. It's about whether this ends up in inflation or deflation. I'm the deflation camp, like 1930s and even 2008 and 9 brushed with deflation. We didn't see hyperinflation come out of that, not even in the recovery. We only seen a little bit now. So that's the difference. Deflationary outcome or inflationary. Most bubble bursts in history, almost all of them end in deflation because money in terms of financial assets and money disappears. Less money chasing goods only leads to deflation in prices, which is good long term. Things cost. What's wrong with things? Do you cry when something goes on sale 50%? That's deflation. I just bought headphones, 50% off. That's deflation. I'm happy. Cost less. It hurts people who are holding assets that deflate. That's losing. So I'm telling people, get out of financial assets, get into solid bonds and cash-like investments, and then rebuy financial assets when they're on their bottom just a few years from now, like Joseph Kennedy did. He didn't have a Harvard MBA to do that. He just common sense and hit the ball out of the park. Sold when the shoe shine boys were buying and thought nobody thought you could lose money on stocks, they'd never go down again, like now, and bought when they crashed, bubble burst down 89%. Simple.
Harry, I love this, Harry. You're like my favorite gunslinger right now, loving every minute of it. Now, Harry, property. It's bloody white hot here in Australia. White hot. Now, you've been calling it to go to hell in a handbasket for many, 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 many years. And you've got a lot of people out here want to shoot you.
Yeah.
That's because you're a cycle guy and bubbles must burst. But the property bubble in Australia, and you mentioned Vancouver and you mentioned Beijing and you mentioned other places, San Francisco.
Sydney, Melbourne, yeah.
Oh,
yeah. London, New
Sydney,
York.
Melbourne. Harry, what's going to be the catalyst to bring this down? Because nothing's happening yet.
Well, you know, one thing, last time around, and I had to kind of figure this out. The last time around, real estate led the crisis. It was defaults on you know, these stupid mortgages they were giving out to anybody that had a pulse with no money down and stuff and low interest rates and stuff. And they started defaulting. Real estate led the crash and stocks followed. So I was assuming that was going to happen this time. No, when I really look at it, real estate was starting to get in a difficult cycle naturally there because it peaks before peak spending. Here, the millennials are actually in a positive real estate cycle, both on starter homes and trade-up homes, and actually more positive just ahead on trade-up homes. So they're the ones keeping real estate high. And builders, the other thing that happened, the 2008-9 collapse hit, just like we said, financial institutions, well, builders got killed, you know, because they go on leverage and stuff. They got killed in that crash overbuilding. So they've been conservative building. So there's not enough supply. The millennials, not the boomers, are driving up demand. Lower interest rates are driving up demand. So real estate's going to be the last thing to peak here. So I've been saying in more recent times, if you really want a signal to get serious about selling your real estate, wait until you see the stock market take that first sharp crash, 30, 40, 50% in the short period of time. If you don't think that's not going to turn into a recession and that's not going to cause real estate, what real estate really needs here is a recession to bring reality to it because it's got some more stronger trends. But the overvaluations are way more in Australia than we have. Canada has more exposure to this real estate bubble now than we do, and Australia does too. So it's really in the developed world, Australia and Canada have the most exposure, and the US is more in the middle. So again, remember, we got whacked before, so our real estate never got, ours has gone crazy, and particularly in the last year again. But that last year, this time now, we're suddenly, instead of going up 10 or 15% a year, which is way more than inflation, which it correlates with 1, 2, 3%. A lot of homes, even here, are going up 20, 30, 40% in months or less than a year. That is more a sign of the orgasm. That's the orgasm comes at the most tense point where it cannot sustain anymore, and then it collapses rapidly. Because think about that. If a lot of home prices have gone up 20, 40, 50, even 100% in some cases in a year, where do they go up 100% or 50% again? Where do you get to the point where you have to be a billionaire to buy what used to be $1 million nice suburban home? That happens if you keep this doubling down. So it will end at some point, but you're right. It has gone longer than I would have ever thought possible. Even this whole bubble, I would have thought, you know, in artificial money, you couldn't have kept it going this long, but the government keeps stepping up bigger. They are going exponential with it, but the exponential is what kills you. It kills you in real estate, kills you in the bubbles the government's creating. So real estate, all these real estate people pushing up prices and, oh yeah, buy it. They're creating their own grave because the one thing that is true throughout history, Greg, two things, when bubbles burst, they burst twice as fast as they build, and the greater the bubble, the greater the burst. The biggest argument I get is not that we're not in a bubble, but people always come up more individually and say, oh, but my real estate is on a pond next to a gold mine, next to a fairyland Disney park, okay? So my real estate can't go down, right, Harry? And I have to tell them the truth is your real estate is great, and therefore it's probably gone up way more than other real estate, which means you go back in the end to the greater the bubble, the greater the burst. It's the high-end real estate investors, the people who paid the most for the best real estate, that will lose the most when the bubble finally bursts. The high-end, the most bubbly stuff will go down the worst. There aren't many exceptions to that in history.
Harry, we're saying there's no inflation. And I know that when I go shopping, I go grocery shopping, there's just been going up and up and up with the grocery bill. When I want to go and buy a nice coat, it's that little bit more expensive. There's an underbelly there. We're not calling it inflation, but things are going up. It's expensive to live.
Okay, now this is, I get this all the time too. There are a lot of things have inflated more. If you look at the general, like 2% or 3% inflation, people saying, what do you mean? Yeah, I go to the grocery store, it feels like it's 10 or 20, okay? There's countervailing things. Low interest rates. Governments have artificially pushed interest rates 2 or 3 percentage points lower than they be. Well, that lowers your car payment. That lowers your mortgage payment for the same size house. Technology, computer, electronic stuff just keeps going down. I mean, I had a 27-inch TV, one of the first high definitions I bought for $5,000 20 years ago. That 27-inch would be $195 today at most. So there's things going down, electronics, financial things, and that's artificial. And there's things like commodities and food. That's why some people are saying, well, if you are going to buy something, buy commodities and gold and stuff, because those things are kind of scarce and bubbling up. But when the economy collapses, the downward pressure will come to that as well. So yes, a lot of things are inflating more, but there's a lot of things that have been deflating, and deflating some of them for a long time. So you have to look at the whole picture.
Harry, the last question is one that leads right into what you talk about all the time. And this is an actual question that came in from somebody that said, what will be the leading sectors that lead us out of the crash? Where's the money going to go? Where's the money trail?
Yeah, I mean, that's the easy question, because you have actually the broader technology companies may not come back as strong as people think after this crash, because the 45-year cycle hits later than the demographic. But blockchain and crypto and Bitcoin in particular are actually the second phase of this last thing, and they are still in their infancy. I think the whole blockchain sector of technology will lead us out of here, as well as things like biotech, but I particularly picked that. Aging sectors in countries like developed countries, nursing homes, pharmaceuticals, that sort of stuff, vitamins and stuff like that, things that people peak and spend more well into their 70s and 80s. Nursing homes peak with older women at age 84. It's the last thing in the baby boom cycle. So those things you buy in the developed countries, but the real power, and this is the most obvious one and not hard to tell at all, emerging countries will account for all of the demographic growth in the future. And the ones that have already peaked slowing are going to be East Asia. It'll be everything else. But the next sector, remember what I said, from east to west around the world, all the way back to the dawn of civilization, back thousands of years ago, the agricultural revolution. It's been moving from east to west. The next hot sectors are Southeast Asia and India, and those are your neighbors. And that would tell me in Australia, as much as I love Melbourne, Sydney, and Brisbane, the city that'll have the most potential growth would be Perth, because Perth is the closest to those growth areas. It's closer to Southeast Asia and even East Asia than Sydney and Melbourne and the East Coast, and it's way closer to places like India. So that would say, hey, things will shift westward naturally in Australia as well.
Harry, thanks for that. This has been an extraordinary interview. I feel one of the best, because you've covered Bitcoin, the where it's going to go, digital currency, where it's going to go, the future of cash. Banks are going to get smashed. There's going to be a big crash coming. The property market has had its moment. It's got to come to an end. We covered some pretty big areas here, and whatever. So once again, Harry, thanks. Great to see you. On our next show, when we're going to have Robert Kiyosaki, we're going to have Martin North, who you know very, very well.
Oh, yeah.
And
Love Martin.
Martin's going to give us an hour
Famous financial analyst in Australia.
Wonderful. Wonderful. Well,
Hands
he's going to be on the program. That's on the 20th of July. So thank you, Harry. I'll let you go to bed. It's getting late there. Good night to you, and we'll see you very, very soon.
Okay. Thanks, Greg. Thanks, everybody.
Goodbye now. And just by wrapping up, everybody, thank you for being such a great audience. And it's been a wonderful program. We look forward to seeing you again very, very soon, again on the 20th of July. And so you all have a great day. Goodbye. Also, make sure you subscribe to the channel. And also, lastly, click on the bell so you can be kept up to date with all the information coming in from the GoGo Group. Once again, thanks for being with us, and we look forward to seeing you real soon.